Hello guys, so today we're going to be going over product knowledge, pretty much all the products that we sell here at American Income Life. Now I'll make this super easy. So far you guys are learning in the script that we have final expenses. Okay. We also have income protection. We also have mortgage protection. And college education protection. Okay, so far you guys have been learning all four of them. However, these are all labels. Okay, and I'm going to explain that in a minute. Now, final expenses, income protection, mortgage protection, college education, they're all pretty much labels that we put on a specific type of insurance. In real life, all of these are either going to equal whole life insurance or term. That's it. We only have whole life or we only have term. We label them either as a final expenses, income protection, mortgage protection, or college education protection. Now, when it comes to insurance in general, there's pretty much two types of insurances out there. You have term and you have whole. First off, they're both really good insurances. Both insurances will pay your loved ones whenever you pass away, regardless if it's health conditions, accident, old age. They will always pay out 100% of the time. Now, the way term works, term is generally less expensive compared to whole. Okay, so whole life is generally a little bit more expensive compared to term. Now, term is less expensive compared to whole, and you get a big sum of coverage. Whole, it's a little bit more expensive. However, you also can get a big sum of coverage. Now, the reason why term is so inexpensive is because you cannot keep it forever. Usually terms, you'll see common 10-year term or 20-year term or 30-year term, and that's it. After that is done, it expires. Someone who is 30 years old and they get a 10-year, they're only protected to the age of 40. After 40, it's done. If they didn't die, then the family doesn't get anything. They don't get their money back, nothing. That's where the word term comes in, because it will terminate. You cannot keep this forever. It's temporarily. After that term is over, you can renew it. However, it will be more expensive because of your age and your health. The older you are and you get life insurance or you renew it, it becomes more expensive. So it starts off really inexpensive. However, later on, it ends up getting really, really inexpensive. Most of the time, too expensive to keep it. Whole, that one, you can keep for the rest of your life. Once you get it, you lock it in at the current age that you get it and the current health, and you can keep it forever. There is a limit, and the limit is till the age of 120, which no one gets to 120, which is why the word whole comes in, because it can last you for your whole lifetime. Now, they're both really good, really inexpensive, a little bit expensive compared to term. One thing that it also has different, term builds no cash value. Okay, whole life has cash value. What that means is, after the person keeps a policy for minimum 2 or 3 years that go by, they're gonna start to accumulate a percentage of money on the side. It's usually 4.5%, not a lot. This is not an investment plan. It's not a way for you to build money fast. Nothing like that. It just builds cash value, 4.5% as you keep the policy, because it does try to help you out in the future. If you ever have an emergency and you need a loan, you can borrow against it. Whatever money you have there, you can do it as a loan. Or if you end up canceling the policy, the whole life, the company, we're going to give you the cash value back, which is not a lot. However, it's better than nothing. So both term and whole are good. And that's pretty much when it comes to insurance in general. Companies will either offer you a term insurance or they're going to offer you a whole. The good thing with us is that we have both products. We carry both term and we carry both whole life. There's another product that you're going to see out there called Universal Whole Life. That is a whole life. It's universal whole life. That means it's going to work with the stock market. It's a different example. We'll go over that much later. So here at American Income, we only sell life insurance. Make sure you guys know that. We only sell life insurance. We have term insurance and we have whole life insurance. That's it. Now, the final expenses is usually done here. Final expenses. Okay, that's recommended here for the whole life. And the income protection, it's here. That's where the income protection goes. Okay, now when it comes to mortgage protection and college education, those are usually another product called ADB, and we'll go over that later. So the reason it recommends final expenses for whole life and income protection for term, simply because your life works like this. Your life is half a circle. First you're born, and then you die. Say you're 20, you're 30, 40, 60, 65. Now generally, between the ages of 0 and 18 or 20, mom and dad is pretty much paying for everything. So you have zero bills. However, you start getting a phone, you might want a car, you want to move out, and you have kids. Anyone will tell you kids are expensive. Kids are not free, diapers are not free, school is not free, school supplies is not free. So generally, you start to accumulate more and more bills as times go by. Eventually, your kids are all grown up, they leave the nest, and your bills go back small. And then you retire, and then you live in a fixed income. However, you don't have that many bills. So your biggest bills are right here when you start to form a family, when you have mortgage to pay, when you have kids to take care of. So term, since you can get a lot of protection for very little money, term is recommended here. Here is where we recommend term, where you most need the money. And whole is recommended here. Now, when you have both products, you have even more protection. So when you pass away in your prime years, your family will have your income protection and will have enough to pay for the funeral. Your term will expire, or it will become too expensive to maintain it, and it's going to go away. However, at that point, you're going to be left with at least a whole life, which is guaranteed to pay for your funeral. There's one thing you have certain in this life is that we're all going to die. So the whole life is guarantee you that you're going to be able to keep it forever. The term will expire, however, you're going to be left with whole life. That's why the computer recommends both final expenses and income protection. Just know that income protection is always going to be term, final expense is always going to be whole life. Now, if the client can afford it, some clients will only purchase whole life because it's more beneficial for them, and some will only purchase term because it's more beneficial to them. Different clients, different people. Okay? Now, that's the difference between a term and a whole, and that's why we recommend both. You'll learn with your manager later on that some people like selling only whole life because we sit down with people that work every day, every class Americans, they go to work, they don't have a lot of money, they want to have something that can guarantee protection for the rest of their life. Okay, now that's the insurance. Term insurance, and whole life insurance. That's the only insurance we have. We do have another product called ADB, okay, which stands for accidental death benefit. ADB. You're going to hear that term a lot. ADB, accidental death benefit. The way this works is that you can give a max of $200,000 of ADB protection per insured. Okay? Max of 200,000 ADB. ADB is usually where the computer will put the mortgage protection or college education protection. This is usually ADB. Okay? Now, what that means is if John has 30,000 of whole life, and then we also give him, call it 100,000 of ADB. ADB will only pay out if John dies due to an accident only. Okay? So if John dies because he has a heart attack, his family will only receive 30,000. If John dies in an automobile accident, his family is going to receive 30,000 plus an additional 100,000. A total of 130,000. Another scenario where the computer will give you, John will have 30,000 of whole life for his final expenses. He will have 60,000 of 10-year term for his income protection. And he'll have, call it 200,000 for college education protection, which is ADB. Okay, that's what the computer will say. Final expenses. This is a 10-year term for income protection. It says protecting 1 year worth of his income in college. Now, if John dies of a heart attack, he has a whole life and a term, so they'll always pay out 100%. So his family will receive a total of 90,000. His family would not receive 200,000 for the college because John did not die due to an accident. If John dies at work, he fell off the roof and died, that is considered an accident. So his family will receive 30 plus 60 plus an additional 200,000. In total, his family will receive $290,000 of coverage. That's what I meant by this are labels. This is labels that we place on top of a term or whole in an ADB. College education does not mean that we're going to pay for the college of their kids. What the computer is saying is that if husband or wife pass away, whatever amount of ADB they have, we will recommend them to use it for the college of their kids, but it's not mandatory. If they want to use it on the down payment on a house, go ahead. If they want to use it to go to Vegas and gamble, go ahead. This is not meant for college only. It's just recommended for college. Same thing for mortgage. If they have 200,000 of ADB for mortgage, it does not mean it's meant for mortgage only. We don't verify that. We just give them a check of the amount they cover, and their beneficiary does whatever they please. Okay? So, now ADB. ADB cannot be sold by itself. ADB has to be attached to either a term or either a whole. Okay? What I mean is, when you sell a policy, you can sell whole life by itself. Yes. You can sell term by itself. Yes. You can sell them together. Yes. You can do whatever you want. However, ADB cannot be sold by itself. Okay? So, cannot sell by itself. Sorry. Cannot be sold by itself. You cannot sell ADB by itself. It has to be attached to a term or a whole. If a client buys a whole life, you're allowed to sell ADB attached to it. If they buy a term, you're allowed to sell ADB by itself. If they buy both of them, you can sell ADB. $200,000 per insured is the max that we can sell. So John can have $200,000 and Jasmine can have $200,000 each. Yes. ADB has to be attached to term and whole. And that's pretty much it, guys. So all of this is what we sell. We sell life insurance. We have term and we have whole. That's it. If you sell term and whole, you're allowed to attach an additional accidental death benefit called ADB. All of these is called a death benefit. All of this is death benefits. They're going to only see this money after they die. Their family will only get to see this money after they die. Both term, whole, and ADB is what equals ALP, annual living premiums. Okay? This is where we get paid on, ALP. Cool.